Most Europeans hold their savings the same way: a checking account. Maybe a savings account paying 1 or 2%. And the vague sense that they should probably be doing something else with it. Fixed income is often one of the first investment categories people explore beyond savings accounts. Government bonds, corporate bonds, money market funds, loans. All variations on the same basic idea. You lend money, you may receive interest payments, and the issuer is expected to repay your capital at maturity. However, returns and repayment are not guaranteed and depend on the issuer's ability to meet its obligations. The question is, which version actually makes sense for what you're trying to do? That's what this video is about. We'll walk through what fixed income actually means, the main options available to European investors, and how to compare them on yield, risk, and liquidity before committing your capital. The information in this video is for informational purposes only and does not constitute investment advice. Always do your own research or consult a financial advisor before making investment decisions. Let's start with the name itself, because it tends to mislead people. A fixed income investment is any instrument where you lend capital in exchange for regular interest payments and the return of your principal at a defined maturity date. The word fixed refers to the structure: a known coupon, a known schedule, a known end date. What is not fixed is the certainty that those payments arrive. That depends entirely on the issuer's ability to honor them. Fixed income investments still carry risks, including the risk of partial or total capital loss. Here is how it works in practice. You buy a government bond worth 5,000 euros with a 3% annual coupon and a 10-year maturity. Every year, for 10 years, you receive 150 euros in interest. At the end of year 10, you get your 5,000 euros back. The same structure applies whether you're buying a bond, lending through a loan security, or parking cash in a money market fund. The mechanics differ, but the contract is the same: scheduled income plus principal at the end. The catch? The issuer has to actually pay, and some are far more reliable than others. So what are your options as a European investor? There are really 5 worth knowing. Government bonds, issued by national treasuries to fund public spending. In Europe, German Bunds and French OATs are generally considered lower risk relative to many other fixed income investments. The trade-off? Yields are usually lower than what corporate bonds or loans pay, because you're paying for that safety. Corporate bonds come next, issued by companies to fund operations or expansion. This is the most diverse segment of fixed income. Investment-grade bonds from established companies pay moderate yields with lower default risk. High-yield bonds pay higher coupons because the issuer carries more credit risk. Then there are bond ETFs, which package dozens or hundreds of bonds into a single fund that trades like a stock. One purchase gets you instant diversification, but bond ETFs don't have a fixed maturity date, so the composition shifts over time as underlying bonds roll over. Loans sit further out on the risk spectrum. These are notes backed by underlying consumer or business loans, originated by lending companies. They typically offer higher yields than traditional bonds, reflecting the credit profile of the borrowers behind them. These investments can involve credit risk, liquidity risk, delayed repayments, and the risk of losing some or all of the invested capital. And at the safest end, you have savings accounts and money market funds. In the EU, deposits are protected up to 100,000 euros per institution under the Deposit Guarantee Scheme. The yields are lower, and over longer time horizons, they've historically struggled to keep pace with inflation. Now, how do you actually choose between them? 4 questions tend to do most of the work. The first is yield versus risk. These move together. A government bond and a high-yield corporate bond both pay coupons on schedule, but the gap in what they pay reflects the gap in the probability of default. Higher potential returns generally come with higher investment risk. Credit ratings make that visible before you commit any capital, which means you can see what you're being compensated for. The second is liquidity versus return. A savings account gives you near instant access to your money, but pays very little. A 5-year corporate bond pays more, but locks your capital up for 5 years unless there's a secondary market where you can sell early. The third is access. Some instruments are easy to buy through any broker or bank. Others, like loan-backed securities, require a regulated investment platform, though those platforms have lowered minimums dramatically over the last few years. And the fourth is diversification. The most balanced fixed income allocations usually combine several types. Government bonds for potentially lower volatility, corporate bonds for yield, loans for non-traditional exposure, ETFs for breadth. So back to that savings account from the start, sitting at 1 or 2%. The reason many investors explore fixed income after savings accounts isn't because there's one better option waiting on the other side. It's because there's a whole spectrum. A safer government bond that may offer higher returns than a savings account, while still carrying investment risk. A corporate bond paying noticeably more in exchange for taking on the credit risk of the company behind it. A loan paying more again, reflecting the borrowers underneath. None of these are automatically better than what you already have. They're answering different questions about income, capital protection, and how much risk you're willing to take to earn more. If you're ready to explore fixed income yourself, Mintos gives European investors access to multiple fixed income options from €50, including bonds and loans. You can handpick individual instruments or use automated portfolios, if suitable, and exit early through the secondary market if needed, subject to demand. Which fixed income option are you most curious about? Government bonds, corporate bonds, loans, or something else? Drop a comment below. If this video helped you understand fixed income better, give it a like. And if you're ready to start building a portfolio that includes fixed income, check out Mintos and see what fits your goals. Thanks for watching. Here's to smarter, more confident investing.